Welcome to the lecture on the discounted cash flow model. With this lecture, we're going to combine the content from last week, all the accounting things that we learned. We learned about the enterprise value and about free cash flows. We're going to combine that with what we learned in the very first week of class with discounting cash flows. Put those two things together, we're going to be discounting free cash flows. That's the discounted cash flow model. Three things within this lecture. As I just foreshadowed, we're going to be discounting the free cash flows to find the enterprise value. That's what the DCF method is doing. In order to do that well, we're going to need to introduce something called a terminal value. When we have free cash flows, for example, in the Mercury case study, we usually only forecast free cash flows for a set number of periods. Firms, however, or projects can go on indefinitely. We think firms are continuing interest, so they're going to generate cash flows kind of as far as you can see into the future. We don't forecast cash flows out into infinity, so we need to have some way to capture all the value that happens after our forecast. That's what the terminal value is doing. And then at the end, we're going to do a few examples. We'll see that if you can find the enterprise value with the DCF method, that's going to allow you to infer the value of the equity of a company. And in fact, this is what equity analysts do. So on Wall Street, folks will try to value the operations. They'll try to find this thing, the enterprise value for a given company, and then they'll work through the balance sheet to figure out what does that mean for the value of the equity? What does that mean for the share price? What should the share price be? And then they take that research and then they sell it to their clients and they say, look, I think the share price should be X. If the price is currently above X, then you should sell, and if the price is below X, then you should buy, etc. That's what they're doing. They're doing this type of exercise. This is a review of what we've talked about in the past couple of lectures. The free cash flows, remember that kind of long formula that's a little bit of a nuisance to keep track of. Free cash flows are equal to EBIT times 1 minus T plus depreciation minus CapEx minus changes in net working capital. We said those are being generated by the operations of the firm. So if you're Apple, that's the iPhone business. If you're Ford, that's your automobile manufacturing. That's the bread and butter of the company. That's generating the free cash flows. When we value these things, we get the enterprise value. Okay, we define the enterprise value as the value of the operations. The free cash flows are generated by the operations. So the second bullet point is just putting those two ideas together. If we can compute the free cash flows and we can discount them, what's going to be the result of that? It's going to be the enterprise value of the company. That's the discounted cash flow method. That's what we're covering today. Here's a reminder of what the market value balance sheet looks like. On the left, we've got cash, and we've got this enterprise value. That's the value of the operations. This thing on the left, all these things on the left, they get split, and they get divided between all the claims on the right. Okay, so the assets get divided to the claimants, the debt holders, equity holders. Maybe you've got preferred equity. Maybe you've got different types of debt. You've got all these different types of investors who are putting money into the company. Those all show up on the right-hand side. Why do any of these things have value? Well, it comes down to the operations. What is the company actually generating? Okay. So for now, we're focusing on this part, the operations, the enterprise value. Once we get a number here, that's going to allow us to work through the balance sheet and infer about the equity of the company. Okay, so that's big picture what we're doing today. A DCF model is nothing more than doing present values like we saw in the first week of class. So if we have a very simple company, it just has one cash flow, say. In this case, you have a firm that's going to generate a free cash flow of $50,000 next year, and then it's going to cease to exist. Okay, so about the simplest company that you can imagine. We have a discount rate of 12%. So what would be the value of the operations of that company? Well, it's just going to be the value of that $50,000. Okay, so the enterprise value is going to be the discounted value of the free cash flows. We only have the one free cash flow, so that's real easy to do. The enterprise value is going to be $44,643. So this is the most simple. We're going to build onto this model. Most companies have more than one cash flow. So if you think about companies that last into the future, into say infinity, if they're continuing interest, they go on as far as we can see. They have a long horizon. That's the more typical case. That's what we're used to thinking about with firms. So how can you value a company like that? Well, if you think that the firm is stable and you think that it's going to stay stable into the foreseeable future, then one simplification you can do is to treat the company as if it's a growing perpetuity. You think that those cash flows from operations, those are going to grow at a constant rate as far as you can tell. We have a formula to do that. We have the growing perpetuity formula right here. In the first week of class, we said the present value of a growing perpetuity is the cash flow that you're getting in one period divided by R minus G. All we've done is we've put in some of these new words that we've learned since then. We've put in the enterprise value instead of the present value. We put in a free cash flow instead of a generic cash flow, and R minus G are the same. Okay, so if you think that the operations are going to generate cash flows that are a growing perpetuity, then you can obviously value them using the growing perpetuity formula to get the value of the operations. So let's do an example here. This company, see, they're established and you think that they are stable. They're in some steady state equilibrium. You know that they're going to grow at a constant 3% rate forever. Next year, the free cash flows are going to be 50 million. They're going to grow at 3% forever, and their discount rate is 8%. We're going to use the growing perpetuity formula to find the enterprise value. The growing perpetuity formula is the cash flow that you're getting in 1 year divided by R minus G. What's the cash flow that we're getting in 1 year? Well, it says right here, that's going to be 50 million, and we have R and we have G. So we just run this through the formula, and we call the result the enterprise value. And so the enterprise value is the free cash flow that you're getting in 1 year. The enterprise value today times 0 is the free cash flow that you're getting in 1 year divided by R minus G. So that's 50 divided by 8% minus 3%. That's $1 billion. That's the basic idea. We're going to try to make things look a little bit more realistic. Right? Most companies don't look like this. Most companies are not growing perpetuities. In the case study, for example, you're going to forecast cash flows out for 5 years, and they don't look like a growing perpetuity during those 5 years. So what are we going to do more normally? We forecast cash flows for some period. So again, with the case study, that's going to be 5 years. You pick some horizon, call that H here. It could be 10 years, case study was 5, whatever. It's going to vary on the context, but the point is you pick some horizon and you're going to forecast your free cash flows out for that horizon. So you're going to do your best to see what's the iPhone business going to generate for 10 years? What's Mercury going to generate in the next 5 years? Okay. You don't forecast those forever though. There's an end date, right? H, some period where your forecast ends. What happens after that? The company doesn't cease to exist. The company is still generating cash flows. So you need to have some way to value everything that happens after your forecast. That's called the terminal value, abbreviated TV here. The kind of clunky definition here is the terminal value is the present value sitting in year H. So it's the year H value. It's at the very end of your horizon. It's the value of all the cash flows that occur after year H. So for Mercury, you forecast cash flows out 5 years. You're going to have a terminal value that's sitting in year 5 that's picking up everything that happens after year 5. Once we have the free cash flows for H years and we have the terminal value that's picking up everything after year H, we discount all of those things to the present to get the enterprise value of the company. In the previous example, things were stable right away. So you just get the present value of this perpetuity and this growing perpetuity, and that's it. If things aren't stable right away, then the timing is a little bit trickier. Here's a picture of what I just discussed with the terminal value. You have some horizon H. In this example, it's 10 periods out. So you're forecasting free cash flows for 10 periods, right? Period 1, 2, 3, 4, 5, 6, 7, 8, up to time 10. Now again, the company doesn't end, right? There's this arrow. That means the company's going to exist after time 10. We need to have some way to value those cash flows. That's all summarized in the terminal value. For now, we're going to compute the terminal value as a growing perpetuity. We're going to assume that the company is stable after your horizon. So after year 10, we think it reaches some stable period. Then we can treat it as a growing perpetuity. We can treat those free cash flows as if they're going to grow at just a constant, smooth rate indefinitely. That gives us this formula for the terminal value. The terminal value is sitting at the end of your forecast, H. So again, you got to remember the first week of class, if it's a growing perpetuity, when does the first cash flow arrive? It arrives one period in the future. So if the terminal value is sitting at H, the first cash flow is in H plus 1. Okay. So this is the week 1 formula, your cash flow in one period divided by R minus G. Now, how do you get this free cash flow at H plus 1? You only forecasted the cash flows up to time H. Remember, you cut things off here at time 10. So how do you get free cash flow at time H plus 1? Well, you just multiply the free cash flow at H by times 1 plus G. After time H, the cash flows are going to grow at a constant rate G. So if you know what the cash flows are at time H, then you know easily what the cash flows are going to be at time H plus 1. It's just going to be whatever they were at H times 1 plus your growth rate. That's how you find the terminal value. Putting all this together, how do you get the enterprise value, the total value of the operations? Well, we have all the free cash flows that we forecasted. Free cash flow at time 1, we discount that like we always do. Free cash flow at time 2, discount that as we always do, all the way up to time H. We have a free cash flow at time H, we discount that. H times as you expect. And then we have this terminal value. And we said that this is sitting in year H. It's the value of everything after time H, but it's all sitting in time H. Okay, so that timing is the tricky part. You just have to do some examples and kind of convince yourself that that's what's happening. So this is sitting in time H, which means you have to discount it H periods back to calculate the enterprise value. So let's do an example. I think that's the easiest way to fix ideas here. We already saw this example. I'm gonna polish off this problem we solved in the last lecture on free cash flows. We had all this data on the income statement and the balance sheet for a company for 2012, 2013, 2014, and I'm just going to turn this into a terminal value problem. I'm going to pretend that you're sitting in 2012 and you want to value the operations of this company. So you're sitting in 2012, say this is what just happened. You forecasted cash flows out in 2013 and 2014. And you want to use that to calculate the value of the company's operations. We're going to use those free cash flows. We already solved for them, so we don't have to do any extra work for 2013 and 2014. What happens after 2014? Our forecast was pretty, it was a very baby forecast, right? It only went out 2 years. So what happens after those 2 years? We have to say something about the company. We're going to assume that the company is stable after 2014. It's going to grow at a constant 2% in perpetuity after that. We're going to use a discount rate of 10%. Okay, so let me summarize everything that we did. Just to remind you of what we did with this example, we did a lot of work to calculate the free cash flow in 2013. We did a lot of work to calculate the free cash flow in 2014. We were left with two numbers for 2013 and 2014, 67 million for 2013, 19.85 for 2014. So let me dock this over here and I'll bring up a whiteboard to help us keep track of our work. Okay, so we're sitting in 2012. We want to value this company. We know what the free cash flows are in 2013, 67 million, and in 2014, 19.85 million. And we want to get the present value. We want to find the enterprise value for this company, where we're sitting in 2012. Okay. So enterprise value sitting in 2012. We're going to discount the free cash flows that we get in 2013 once. We're going to discount the free cash flows that we get in 2014 twice to bring it back to 2012. Then we have this issue of what happens next. We didn't solve for the free cash flows in 2015, 2016 forever, so we have to do something about that. Okay. That's what this second bullet point is telling us. We're going to assume that the firm is stable at the end of 2014. The free cash flows are going to grow at 2% thereafter. We're going to combine that with our discount rate of 10% to get a terminal value. We have growth, the long-term growth rate of 2%. So if we know what the free cash flows were in 2014, and we know that the growth is 2% for free cash flows after 2014, that means we can figure out what the free cash flow is going to be in 2015. It's going to be simply the free cash flow that we had in 2014 times 1 plus G. Okay, so 19.85 times 1.02. Plug that into your calculator to get about 20.25. So that gives us the cash flow for 2015. We could continue this process as far out as we want. We could keep growing the cash flow in 2016 by another 2%, 2017 by another 2%, but we don't need to do that. You know, if you're really insecure about your answers, you could set this up in Excel and calculate the free cash flows, 100 or 1,000 years out and value them to make sure that you're getting kind of the right number here. Excel can do these calculations and no problem, but we should be able to do it without a bunch of computation. We know that things are going to look like a growing perpetuity going forward. So let's talk about the the terminal value. It's going to capture everything after our forecast, everything after 2014. Because it's a growing perpetuity, we're going to use the growing perpetuity formula. The terminal value is sitting in 2014 at the end of our forecast. So if the growing perpetuity is sitting in 2014, that means the first cash flow must be arriving in 2015, 1 year ahead. Again, that's week 1. And that's the rest of our growing perpetuity formula, cash flow divided by R minus G. We solve for the free cash flow in 2015. We saw that's 20.25. So that's what we're going to throw into the growing perpetuity formula. And then we're given a growth rate of 2% and we're given a discount rate of 10%. That allows us to find the value of all those cash flows that occur after time 2014. We're going to get 253.13. Okay. We don't need to know anything after 2014. Once we calculate this terminal value, that's picking up everything that's happening after 2014. So we don't need to touch those cash flows anymore. In particular, when we go back to our enterprise value formula, instead of adding the free cash flows for 2015, 2016, 2017, all we're going to do is we're going to add the terminal value that's sitting in year 2014, and we're going to discount that twice now. And this thing includes everything that happens after 2014. That allows us to value the company. We have a free cash flow of 67 in a year, so we discount that once. We have a free cash flow of 19.85 in 2 years, so we discount that twice. And we saw that the value of everything after that is this 253.13. And that's also sitting 2 years in the future. So we discount that twice as well. This is the value of the operations then under these assumptions. You put all that into your calculator, you'll get about 286.50 for the value of this company. Okay. So hopefully that we'll do more examples like this, but they're all going to have these same mechanics. You're going to forecast the cash flows out for some horizon. In this example, it was just those 2 years. After those 2 years, cash flows are going to be stable going forward. So you'll need to figure out the cash flow in the 1 year past your horizon, because that's what shows up in the growing perpetuity formula down here. Right? You need to know what happens 1 period ahead of your growing perpetuity. That gives you the terminal value, which is going to capture everything that's outside of your forecast. You have the free cash flows, you have the terminal value, put it all together to get the total value of all the free cash flows here. Another note to see is that this terminal value is very important, and it's not something that we can get away from very easily. So if you look at this, the present value of that first cash flow, that's 67 divided by 1.1, that's about 60. Present value of this second cash flow is 17 or something. So the value of this last cash flow, the value of the terminal value, the present value here is about 200, right? That's giving us the 200 out of this 286. And unfortunately, that's just going to generally be a problem. The terminal value is going to be an important part of your valuation. And so the assumptions that you use for that are going to drive your valuation in a lot of cases. So you have to be mindful of that. So that brings us to notes. We've talked about the mechanics. We've talked about the logic. I'm going to fill out some of the kind of finer points for the terminal value next. The first thing you may be wondering is about this G. So where is this coming from? We said it's the long-term growth in the free cash flows. The unfortunate answer is that G is very hard to pin down. We kind of wave our hands a bit. So you have to think a little bit about the fundamentals of the business, but you're not going to get a very precise answer for what G should be. It's more guesswork, more art than science here. So you want to link G to industry growth rate or something in the macroeconomy. So you can think about Walmart. We all know Walmart. Walmart is operating in a pretty saturated business. They're probably not going to grow very fast going forward. So maybe they're at a stable, steady state. How much can Walmart grow? Well, probably not much faster than population plus inflation. So you put those two things together, maybe their long-term growth rate and their free cash flows can be like 4.5%. Again, it's more of an art than a science, but that would be one kind of reasonable way to approach G. This is going to be an issue because our valuation is going to be highly sensitive to this. Even if you're forecasting your cash flows out 10 years, your terminal value is still going to be a large portion of the firm value. If the company is going to live for 40 years and you only forecast the first 10 years, then that means that years 11 to 40 are all going to be summarized in the terminal value. And so changes in your G are going to, so that's going to be a big thing, right? Those cash flows from time 11 to time 40 is going to be a big sum, and small changes in your long-term growth rate are going to have a big effect on that sum. So one approach you can do to try to get at this issue is something called sensitivity analysis. We'll introduce this after the first midterm, so you can keep it on the back of your head for now. The idea with sensitivity analysis is you want to change your assumptions. You want to see how does your answer, how does your valuation change when you change certain assumptions of your DCF model. So in particular, you want to try different levels of G. You want to find the enterprise value of the company for a high level of terminal growth, kind of an expected level of growth and a low level of growth. And you want to get a sense of how robust is your estimate. If your estimate doesn't change very much when you change the assumption, then that's pretty good. You're pretty confident in your valuation. However, if your valuation is swinging wildly based on small changes in G, then you're going to be a little bit more careful, a little less confident in the number. Another approach is to estimate the terminal value in multiple ways. So what we've done is we've estimated the terminal value as a growing perpetuity. Right here, this is the growing perpetuity formula. There are other ways to try to get at it. One thing we'll talk about towards the very end of class is valuation using multiples. Okay, so again, keep this in the back of your head. We'll come back to it. The idea is that instead of trying to model the cash flows as a growing perpetuity, you use some kind of accounting number and link that to the valuation. So we saw the PE ratio, for example. We saw that when we covered stocks and bonds. So the PE ratio is the price per share divided by the earnings per share. So you could use something like that to try to figure out what the company will be worth at the end of your forecast. If you could forecast your earnings, for example, to the end of your forecast period, you have your earnings. If you figure out what a good PE ratio is and you have your earnings, and then you can figure out what the price should be, right? You can figure out what the company should be worth at the end of your forecast. But more on that later. So this first slide, we've reiterated that it's very sensitive. In this class, I'm just going to give you a G. Things are going to be very simple. I'm just going to tell you what the growth rate's going to be. But that's not super appealing. You should know that there's these other, there's these methods to try to measure how important G is and try to get other ways of the terminal value. Okay. Another thing I want to talk about, again, the finer points of this G, is what does it mean to say that the free cash flow is growing at a constant rate? We've got some G, where's that coming from? What does that mean about the fundamentals of the business? Well, intuitively, if your free cash flows are growing at some rate G, that means that this whole sum is growing at a rate G, right? EBIT times 1 minus T plus depreciation minus CapEx minus increase in net working capital. This whole thing has to be growing at G in order for your free cash flows to grow at G. Okay. So one way to do that, one common way to model this terminal growth is to tie each ingredient to your sales, your revenues, and then have your sales grow at a constant rate. So what we'll see is that you can assume that your gross margin is going to be constant. Basically, your profit margin is going to be constant. So that means that however much you sell, a fixed fraction of that is going to be profit. So if your sales are growing at a constant rate, then your profit's going to be growing at a constant rate. Likewise, we can think about investments in new assets, CapEx, and increases in net working capital. If you can tie those things to sales, you need a certain level of investment to generate sales. Then if sales are growing at a constant rate, then your investments in your assets are also going to grow at a constant rate. Okay, so we're going to link everything to sales, and that way each piece of this ingredient, each piece of this formula can grow at a constant rate. Don't worry about this slide. This is just the derivation. This is telling you exactly what it means and showing you that if everything gets linked to sales, then that means each ingredient of the free cash flow formula is going to be growing at the rate that sales grows at. We'll summarize with these bullet points. You can model a constant growth in free cash flows if you assume that sales are going to grow at a constant rate G. You have a constant gross margin. Okay, so this is your EBIT, right? Sales minus operating expenses, that's the main component of your EBIT. If this ratio is constant, when sales grows at a rate G, that means that your EBIT is going to grow at a rate G. your operating assets over sales is constant. So the intuition here is you need a certain level of assets to support your sales. So if your sales are growing at a constant rate, that means that your assets are growing at a certain rate, which means that your investment, your CapEx, and your increases in net working capital, those are growing at a fixed rate G as well. And finally, we're going to keep depreciation over your assets constant. And the idea is that your assets are losing value at a fixed rate over time. If our operating assets are tied to the sales from point 3, and our depreciation is tied to the operating assets, that means that your depreciation is going to change at the same rate as sales. Okay, so everything's going to be changing at rate G, which means your free cash flows are going to be changing at rate G. So how would you put this to work? How do people do this in practice? When you forecast your free cash flows out, say 5 years or 10 years, ideally, you want to forecast the cash flows far enough so that these rates here, these rates 1 through 4, you want those to stabilize. Once these things stabilize, then you're in a steady state, and then you can figure out what this G is that your free cash flows are going to grow at a constant rate. Okay, so yeah, that's called the steady state. From then on, you can treat the free cash flows as if it's a growing perpetuity because you've reached the point where these 4 things have occurred. We're going to turn now to think about the value of equity. So we've talked about the finer points of this terminal growth rate. Now we're going to go back to examples, do more examples, and see how we can learn about stock prices from this DCF analysis. We saw that the DCF is going to give us the enterprise value. We discount all those free cash flows. That gives us the enterprise value. That's DCF. Well, what can we do with that? We can recall that the balance sheet identity gives us this relationship between the assets and the debt and the equity. If we know the value of the operations from this DCF approach, we know EV, it's pretty easy to value cash. You just look on the balance sheet, see what the cash is worth. It's also generally not too hard to value debt. As long as the company is not going to default, as long as it's relatively safe debt, it's pretty easy to value debt. Therefore, we can infer the value of the equity based on what's going on with the assets. So if you're an analyst, you're going to be able to say something about the stock price. You should say what the stock price should be based on what the assets are worth. So let's do an example to fix ideas here. Cougar Corporation expects that they're going to have free cash flows that grow at a rate of 16% up until time 4 for the next 4 years. After that, growth is going to slow down to 3% in perpetuity. So you can think about this as a startup. Right? Startups have pretty high early stage growth for 4 years, and then eventually it slows down into a more mature company. We're going to estimate that the free cash flows will be $35 million in 1 year from today. The third bullet point gives us some information on the balance sheet. We have $25 million in cash, $140 million worth of debt. We have 13 million shares outstanding. And the question is, you're an analyst. You want to value you want to get the enterprise value of this company. Then you want to figure out what the equity is worth. And finally, you want to get the share price, assuming that the discount rate for the operations should be 12.5%. Right? You want to know how much would you be willing to pay for this company on the stock market. So let's set this up. I'm going to set this up in Excel. It's going to be a little bit easier. Okay, so we're going to be sitting at time 0. We want to forecast the free cash flows for this company. We're forecasting a high level of growth up until time 4. So I'm going to forecast things out to time 4. And then, we can go out further, but we don't need these numbers because we're going to get a terminal value. We're going to get a terminal value that picks up everything after time 4. So we're not going to put these numbers into our DCF. I'm just going to put them there. That there are cash flows after this. What are our free cash flows? Well, it's given at $35 million in 1 year. And then it's going to grow at 16% up until time 4. So how did we see how to do this in Excel? Well, we type equals, so Excel knows that we're typing a formula. We're going to refer to the previous cell. We're getting $35 million in free cash flows at time 1, and then we're going to grow that at 16%. So at time 2, we're getting 41 in free cash flows. Time 3, we're getting 47. Time 4, we're getting 55. Okay, I just filled over the formula where I'm taking the previous number and multiplying it by 1.16. Okay. After time 4, what's going on with the cash flows? Well, now they're only growing at 3%. And this is a 2-stage growth, fast growth and then small, low growth. So I'm going to take the free cash flows that we had in time 4 and just multiply that by 3%. Okay, so now it's only going to be 56 at time 5. We can forecast this out, as far as you want, time 9, 10, whatever. You can forecast those in Excel pretty easily. Okay. We're not going to forecast the cash flows out to infinity. We want to use a terminal value to figure out what the cash flows are worth from time 5 on. We can value the first 4 cash flows pretty easily, just using the present value formula. So what's the present value of that first cash flow? It's the cash flow itself divided by 1 plus R, which is given at 12.5% in the slides, right? That's our discount rate. So we're going to discount that first cash flow at 12.5%, raised to the time period. Okay. I'm going to do that for the first 4 periods. Right, so how much is that $55 that we're getting at time 4 worth? Well, it's equal to 55 divided by 1.125 to the 4th. Okay, so we set things up like this in Excel in the present value lecture. It's going to be useful for the rest of this class. Okay. Now with Excel, you could extend this kind of as far as you want into the future, but you can't go into infinity. And these cash flows are assumed to be going into infinity. So what we need is a terminal value to pick up everything that occurs after time 4. I'm going to label that the TV. Recall what the terminal value is doing. I'm going to put that up here on the whiteboard. We need a terminal value that's sitting in year 4. Okay, because it's sitting in year 4, it's going to be picking up everything after time 4. So the first cash flow that gets put into the perpetuity formula is the free cash flow that you're getting at time 5, and then you divide it by R minus G. And that's it. That's going to include all the free cash flows from time 5 to time 6, 7 through infinity. So we don't need to deal with any of those numbers. We can go all the way out to, column XFD in Excel. We don't need to care about that stuff. It's all going to be summarized in this one simple growing perpetuity formula. So let's have Excel set that up for us. I'm going to type this formula of the free cash flow at time 5, which we figured out is here at 56. Then we're going to divide that by the discount rate of 12.5% minus the terminal growth rate, which was given at 3%. We have a terminal value of 592, and we've got, I'm going to move that up here. And then we've got all of these present values. This terminal value is sitting in year 4. Remember what we wrote here, it's sitting in year 4, so we need to take the present value of that. That means we need to bring that back to the present. So I'm going to add an extra row. It's going to be the present value of the terminal value. these numbers here were the present values of each of those first free cash flows, those first 4 free cash flows. We also need the present value of the terminal value. How can I do that? Well, just like you can discount any single cash flow, you can discount the terminal value 4 times. Okay, it's sitting in year 4, so we discount it 4 times to get the 370. If this is still a little bit unclear to you, you can go back to the present value lectures and see what we talked about when we said we're moving shortcuts through time. Okay. In this case, the shortcut is the growing perpetuity formula. It's sitting in year 4, so we got to bring it back to time 1, or to time 0, excuse me. So we have seen this before. We've seen this a few different times now. We saw it with stock valuation, where we did an example where Microsoft didn't pay off a dividend, didn't start paying dividends for a few years out in the future. So what did we do? We valued the dividends as a growing perpetuity starting in year 3 or something, and then we had to move those back to the present to get the present value of the company. It's the same exact logic here. We're just putting in something called a terminal value. We're just calling it something different. So back to this problem, we have the present value of the first 4 free cash flows, the present value of the terminal value. So put all that together, what is the enterprise value of this company? It's just the sum of all of these present values. We get about $500 for this company. Yeah, 500.16 here. And all these cash flows are worked out in the slides if you want to see them kind of a different way. If you don't want to see them in Excel, you can see them in a table format here. Okay. Oh, so now that was the value of the operations, the enterprise value. The question was asking for more than that. The question was asking for the value of the equity as well as the value of the share price. Okay, so let's bring up a balance sheet. We figured out that the enterprise value was 500. Okay, that's what we figured out with all of this discounting of free cash flows. We got 520. We further know from the problem that the cash is worth 25 and that the debt is worth 140. So recall the balance sheet identity. The balance sheet said the assets have to equal debt plus equity. So we have 2 types of assets, the enterprise value plus cash. That's going to be equal to the debt plus the equity. We called this whole thing the balance sheet identity. We have the enterprise value of 520. We have the cash of 25. We have debt of 140. And we just don't know the equity. But we can solve for the equity here. We have 525.20 minus 140 is going to be the value of the equity. So you can plug this into your calculator real quick. 525.40 minus 140, we get 385 for equity. Now, the last step, if you're an equity analyst, is to try to figure out the share price. You want to have some number and say, this is what the share price should be. If it's more than that, then it's overpriced. If it's less than that, then the share is underpriced. If all of the equity is worth 385 million, and you know that you have 13 million shares outstanding, then you know the value of each share. The price per share is going to be the total value of the equity divided by the number of shares. You're just divvying things up based on how many shares there are. So we have 385 divided by 13 million. $385 million worth of equity divided by 13 million shares. That gives us a share price of about $29.65. And that's it. That was what the problem is asking for. It's a bit involved. You see, we have to first find the value of the operations. Then you work through the balance sheet identity to find the value of the equity. And then you figure out the share price. On a test, this would be a 3-part or 4-part question maybe. First, you figure out the value of the first free cash flows, then maybe find out the value of the terminal value. That could be part B. Part C could be finding the enterprise value. Then part D would be the value of the equity and the value of the shares. And you can look up analyst reports. You can do this through UH's library. So I want to pull that up real quick because it's kind of neat to see. So if you go to the UH library website, you'll see a web page like this. You can search. You look for databases. The database that has some analyst reports is called Business Source Complete. So you just search Business Source Complete here. It's going to show up. There we go. Then you can search for something called the Bernstein Black Book. So the Bernstein is a research company on Wall Street. They will publish some of their reports. Now, it's not a ton. You're not going to see a ton here. It's a little bit of a selected sample. It's kind of the highlights. It's what they want you to see. They're almost marketing the best of our analyst reports that we've done. They'll publish them and send them to the library. But it's still kind of interesting to see what these can look like. See what the pros are doing. See that you see these numbers. You see free cash flows in the analyst report. You see the enterprise value divided by free cash flows right there. They're forecasting these things out into the future. So it's kind of interesting to look through that and see how they derive what the stock price should be based on their research. Okay, so you go to this Business Source Complete database. You search for Bernstein Black Book and like Apple. You can search for a company to see what reports they wrote on that company, and so you can get a whole list here with various tables and figures that look like this. So you may want to check that out if you're curious. Let's do one more example just to make sure we're on the same page. We're going to go through the same steps as before. We're going to have some free cash flows that we forecast in the future. Then we're going to have some terminal growth. We're going to calculate the terminal value of the company after our forecast. That's going to give us the enterprise value. We're going to put those things together to get the enterprise value. Then we're going to work through the balance sheet to figure out how much the equity should be worth. And then finally, we'll get the share price. Like before, I think it's easiest to set these things up in Excel to see everything piece by piece. We have the cash flows from years 1 to 5. Those are just given. So in year 1, it's going to be minus 27 million. In year 2, it's going to be minus 11. Then year 3, it turns to 0, 6, then 33. Okay, those are just explicitly given. Those are our forecast. So again, for Mercury, these are what you're doing for those first 5 years. You're getting those free cash flows. Now, what happens next? The free cash flows are going to grow at a rate of 5% after year 5. So we're at time 5. We get a free cash flow of 33. To time 6, we're going to grow that 33 by 5%. How do we do this in Excel? We tell Excel, look at 33, multiply it by 1.05. It's going to grow to 35. Okay. Again, you could fill this over and see what the cash flows would look like in year 7, 8, 9, 10. But we're not going to need that because we can use the growing perpetuity formula to capture everything after time 5. But it may help you if you want to double check your work. You can forecast all of these things out again to time XFD, whatever number that is, and then double check your valuation that way. But we're not going to do that. Okay. So these are our free cash flows that we need. We need a terminal value that's going to pick up everything after time 5. We're going to use a growing perpetuity formula just like we've been doing. So the growing perpetuity formula is obviously C divided by R minus G. What's our cash flow? It's going to be the cash flow in 1 year ahead. So at time 6, we have this $35. That's going to be the cash flow that we put into the terminal value formula. We have the discount rate given at 21%, and we have a terminal growth rate of 5%. So you put all that together, this 217, this is the time 5 value. Oops, I want that. Of all the cash flows after time 5. Cash flow at time 6, 7, 8, on and on and on forever. All of that gets captured in this 217. Okay. After that, we have the free cash flows, and we have free cash flows going to infinity captured here. So we're just going to take the present value of all of these things and then add up those present values. So what's the present value of each free cash flow? We're just going to go through the present value formula. It's the cash flow divided by 1 plus R raised to the T. So we get minus 22, minus 7.5, 0, 2.8, and 13. That gives us the present value for those first 5 cash flows. We also need to separately get the present value of the terminal value, which is sitting in year 5. It's a time 5 value of everything after time 5. The present value of that is 83. When we add up all of these things, we're going to get the value of all the free cash flows. Forecasted the first 5, and then everything after that gets picked up in the terminal value. Okay, so that's our answer for the enterprise value. Again, we want to figure out the value of the equity, not just the value of the operations. So let's pull up the balance sheet here. We see that the operations are worth 69.19. We just solved for that. Let's see what else the company has and think through the rest of the balance sheet. It's got $17 million in cash. It's got 19 in bank debt. It has a loan from a supplier of 8. And then we don't know anything about the equity. But we can add up the assets. All we have are the cash and the enterprise value. So the total value of those things, if you add them up, is going to be 86.19. That's the value of all the assets. The balance sheet identity means that 86.19 is also the value of all the debt and the equity. Therefore, what's left, we don't know what the equity is worth. We're going to figure that out. The equity must be worth 59.19. How did we get that? Well, we know that the 86.19 is the value of all the debt and equity. So that's the $19 in bank debt plus the $8 in the loan plus the equity, which we don't know, but we can solve for that. The equity is going to be the 86.19 minus 19 minus 8. That's 59.19. Okay. And then last thing, we're going to find the value of each share. If the equity is worth 59.19 million, the share price It's going to be the value of the equity divided by the number of shares. So we have 59.19 million divided by 4 million shares outstanding. So we'll get about 15. Let's see what it is exactly. Yeah, 1480. So again, if you're writing an analyst report for your clients, you would tell them to buy the stock at 1480. If it's trading at more than that, then it's overpriced and they should sell, and vice versa. So that's everything for the DCF model. As you can see, we've seen all of this before. It's just we're putting on new words. We've discounted a bunch of stuff before. Now we're just discounting things called free cash flows. Instead of getting a present value, we get something called an enterprise value. We've already moved shortcuts across time before. That's as old as the first week of class. But we're doing it again, and we're calling it something different. We're calling it a terminal value now, because it's starting at the end of our forecast, and it's picking up everything after our forecast. And finally, we already saw the balance sheet. We're just working through those implications. If we know the value of the assets, we can figure out the value of the equity. Okay. So that's all I have for this slide deck. We'll do much more practice in the next slide deck on project evaluation. Thanks.